Whether it's learning about earnings estimates, exploring the Zacks Rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. You know, on the Zacks.com website, there is plenty of information about the Zacks Rank's impressive 30% annualized return. And we also provide insight on how to use the Zacks Rank. But the question that you, our viewers, keep bringing up is, why does it work? So, for the answer, we bring in Steve Reitmeister. Steve is our editor-at-large and wears a few other hats at Zacks.com.
I need the hats, so, by the way. Yeah.
Don't take me down that road. So why? Why does it work?
Yeah, I think we've spent so much time on the details. What are the factors behind the Zacks Rank, and what do the different signals mean? When do you buy and when do you sell, and the performance numbers? But yeah, I think what we left off the table is, why does it work? Because some people need that fundamental understanding of, well, that's great. I buy Zacks and One Rake stocks and I sell number 4, but why does it work? Why do the stocks go up? So Today, let's tackle that for folks.
Okay.
For me, this is kind of the statement that brings it together. At the end of the day, all stock price movements can be traced back to earnings. And you see, that's the funny thing about investing. There's so many news outlets, there's so many websites, there's so many newsletters, magazines, and so on, and everyone's pitching a different way to take a look at companies. But really, if we're talking about the ownership of companies, which is what buying stock is all about, we have to be talking about earnings. And so let's simplify this thing, because here again, we often get too confused because we're talking about IBM and Cisco and Johnson & Johnson, bigger companies. Let's simplify it and say, if you and I were to go out and buy a very simple company like a hot dog stand, okay, would we be interested in whether the hot dog stand had a cup and handle chart pattern? Right, the answer is no. We'd be asking the current owner of the hot dog stand, well, tell me about your revenues the past few years and your cost structure, and therefore, what have your profits been the last few years?
Right.
And given their profits in the past, we're going to try and think about, once we own the hot dog stand, how much profits we're going to be making in the future. And given that future projection of profits, we're going to figure out what we're willing to pay for that hot dog stand today. Mm-hmm. And when we start to realize that, this is the basic concept of fair valuation model, okay, of how we value companies. And now we can start talking about, the large cap companies again, because guess what? The institutional investors do invest in these stocks in these same ways as we're talking about the hot dog stand. So that's where we get to, the stock valuation models, which is what billions of dollars are traded every day in the stock market about. So we say the stock valuation model is the fair value of a stock. In other words, what people should be willing to pay for a stock is the present value of a future stream of earnings. Okay, here again, a fancy way of saying, what are the earnings in the future, and what am I willing to pay for that today? This is the way that companies are valued. And here again, pushing away all that other noise, it is about earnings.
Right.
Now, once we start to appreciate that, then we say, okay, if that's the way companies are valued, then if earnings estimates go up for a firm, right, the projection of future earnings, then the fair value comes up. Fair value comes up, there will be more investor interest, and people will buy more of the stock, and the stock price will go up. It's the most natural occurrence in the world. It's the way the stock market has always worked, and I don't see any reason why it wouldn't work that way in the future.
Okay.
And on the way down, earnings estimates go down, fair value goes down, investor interest goes away, and the share prices fall. As I said, these are the most natural occurrences in the world.
That's a pretty good explanation of the importance of earnings and earnings estimates.
Yeah.
So then, how does the Zacks Rank harness the power behind earnings estimates, as we say all the time, for the benefit of investors?
I want to give a little bit about the background of Len Zacks, our owner, and kind of the chain of events that occurred that led him towards tapping into earnings estimates, and I think it will all become very clear here. So Len Zacks is a PhD in mathematics from MIT. And one of the things that I enjoy about Len is he doesn't look at himself as a market guru or a phenomenal stock picker. I mean, he is a mathematician, and that's a form of research or a scientist. I mean, he needed something that was verifiable fact. And so the model that he worked on is not, his emotions about the way the world should work. It is the way that the stocks work, and that the model had to stand up to his scientific scrutiny. So he took his mathematical talents and became the director of research for a brokerage firm in the mid-'70s, and his job was to find models of stock picking, strategies that would stand up against the test of time. Fact is, most things don't really work. They may work in bull markets and then fall apart in bear markets, or vice versa, but he needed something that was going to stand up against all market environments. So he started this theory about earnings estimates. Okay, this is where it's starting to come together. What he said is, stocks that have positive earnings surprises, they jump on that news, and stocks that have negative surprises fall apart on that news. If you were to have a leading indicator, beforehand, buying these stocks beforehand, which ones were more likely to have positive surprises and stay away from the negative surprises, that would put a big advantage in the hands of individual investors. So he concentrated on that. And from that work, that's where he discovered 4 different factors of elements that were leading indicators of companies likely to have positive earnings surprises, likely to see their earnings estimates go up. And here again, from that thing we were just talking about, if earnings estimates go up, fair value goes up, and investor interest goes up in those stocks. So 4 leading indicators. With that, he blended the 4 factors together to create the Zacks Rank.
And you have covered those factors individually,
yes,
in separate videos, but let's go over them real quick. Again.
We have 4 separate videos, one for each of the different things, go in depth as you're saying. So here again, I'm going to go on the very brief here, but these are 4 factors that each one Len found was very indicative of where future earnings surprises would be, of where the future estimates would be, and each is powerful in their own right. So agreement is about the movement or the agreement of analysts whether estimates are going up or going down. Okay, and this is the biggest of the factors. So the more analysts are in agreement that's going up, the better. Magnitude is, okay, agreement's nice, that's the direction, but how big of a move? If earnings estimates go from $1 to $1.05, well, that's a 5% move, that's nice. But going from $1 to $1.20, a 20% move, that's better. And that's what magnitude is about, the size of the change of consensus estimates. Okay, and here again, consensus estimates, the average of all estimates that are put out by the Wall Street firms on a company. Upside is taking a look at the difference between the most accurate estimate for a firm and the consensus estimate. To explain the most accurate estimates, too long for what we're doing today. There's a video on Upside that goes into that in detail. Certainly take a look at that. But it's what we believe is a leading indication of where actual earnings will be, a great leading indicator of where future agreement, magnitude, and surprise will be, and a powerful indicator that most people are not aware of. And then surprise, companies that surprised in the past are more likely to surprise in the future. And as I said, each 4 of these elements are powerful in and of themselves. Each 4 of these elements, you would find the details for them for free on Zacks.com. But here again, the Zacks Rank kind of blends them together and makes it easier for folks.
Well, let me get a little crazy here then,
okay.
Because, and I'm just the media guy, so I can get away with this. But if the data of the 4 factors is available for free on Zacks.com, then why would anybody pay for a subscription for access to the Zacks Rank?
Right. Well, that's a good point, and I think it's a combination of factors. So I'm going to bring up the Zacks Rank table here, and this will kind of help me explain the benefits.
Okay.
One element is obviously performance. Okay. You can take a look at the individual elements of the agreement, magnitude, upside, surprise on the Zacks.com website, but here again, how will you know how to blend them together to create effective buy-sell signals? Now here again, Len, he spent many hours researching this, and he put together those factors in the right way. And take a look. It's one thing to have a rating scale that's very clear. Okay, this is the ones that I buy, this is the ones I hold, and which ones I sell. But more important, are they meaningful? Are they profitable signals? As you see, if you start at the bottom, the strong sells created a 2.2% return. Each time you move up to the higher levels of rating, it produces additional performance. And obviously, we go all the way up to the top. Strong buy stocks up 30.46%, 3 times the rate of the S&P 500. That is a clear signal. That is a meaningful signal. So here again, you can spend the time yourself. And I know folks, they like to spend all night long to research stocks because it's a hobby of theirs. And I'm not making fun of them. I think that's terrific. They want to put in the time and effort to do so. But for the rest of us, if that's not our life's passion to be spending 40, 60 hours a week doing that kind of research, you want a clear signal and a profitable signal of what stocks to buy based upon this earnings information. Then that's why I use the Zacks Rank.
And the important ingredient here is that it is time tested.
Time tested since 1988. Here, that's a lot of bull markets, that's a lot of bear markets,
Right.
and a lot of sideways markets, and it has stood up against all of them.
Well, there you have it, folks. The full lowdown from Steve on why the Zacks Rank works. And all of this information and more is housed on Zacks.com. With Steve Reitmeister, I'm Terry Ruffalo.